Okay, I think a few other people are still logging in, but let's go ahead and get started for today. I just want to welcome everybody and thank you for joining us today on your Wednesday. Today, we're going to be giving you a little bit of a behind the scenes look on how CAM clients invest with confidence. So especially during times of uncertainty, whether it's market volatility, economic shifts, or different headlines that kind of drum up some doubt. Our goal is to really help those that we work with to be able to stay calm and stay on track. So today joining us, we have our team here. I'll introduce Jordan Bennett, our associate who has recently rejoined the CAM team again. And some of you may remember her. She worked with us part-time while finishing her master's degree a few years ago. She moved away from Denver, but recently moved back and is back with us again. And we are very excited to have her. She brings a lot of talent to the CAM team and has always been wonderful working with our clients. So we are excited to have her and with us today too. So I'll say too, if you can't get a hold of Mark or myself, Jordan, reach out to her. She'll definitely be available to help you as well. Also joining us today, we have Marc Jimenez, our fearless leader and founder of CAM, Chief Investment Officer and Senior Wealth Manager, and pretty much chief of everything for us here at CAM. And then I am Sarah Contino, Senior Wealth Advisor here at CAM. So today, we're going to talk about 3 key strategies that drive our clients' confidence. So Jordan, if you want to hit the next slide, before we really hop into our agenda here, we also just want to cover a couple of basics. Disclosures, this is so we can keep our compliance folks happy. And if you want to go to the next slide for us, we're just going to go through a little bit about CAM. For those of you who maybe don't know us in depth or don't know as much about us, we have 3 locations. We're in Colorado, I'm here in Florida, Mark is in Austin, Texas. So we do provide a lot of investment advisory planning services to individuals, families, executives. We are a registered investment advisor, fee-only advisory firm. And that's just a little bit about us. So let's go ahead and hop over to the agenda. So we're going to obviously talk today about, what are the 3 keys that help to make our clients confident. And why we're covering this is because we see most of our clients come to us. Honestly, they're just not feeling confident. I would say once they cross our threshold and we're meeting them for the first time, that's usually a big part of what drives people to start to seek help. And that's usually the number one feeling that they have. And I would say they're not alone in that, because depending on what study that you're reading, there's really anywhere from like 17 to 23% of individuals that feel pretty confident in their investment or financial lives, but that leaves, nearly 3/4 of folks that are not confident to some degree, whether it's, very unconfident or just mildly unconfident. So, today we want to be able to kind of share with you, kind of go behind the scenes about what are 3 major things that we do for our clients so that they do feel confident. So let's go ahead and hit the next slide. And number 1 is why CAM clients stay invested. The first question we always ask our clients, if you want to go to the next slide for me, Jordan, is what has changed, right? So we're going through some of these market volatility events like we have been, and this is not the first time that we've seen something like this. One of the first questions that we'll always ask is, what has changed? So has your plan changed? Have your goals changed? If your date for retirement hasn't changed, or if you're not planning on making a big purchase, if nothing like that is really occurring, and even if we're hitting an event with a lot of volatility, then usually the answer is no, we're not going to do anything different. We're going to stay the course. One analogy that I love to use with some of my clients is if we're hopping on an airplane to fly somewhere. Now, Mark knows still, he's known me for many years, I don't love to fly, do not love getting on an airplane. But I know, and I think all of us know, that when we get on an airplane, we're probably going to incur some turbulence. Like, that's a given. It might be, next to none, it might be a lot. What can happen when we hit turbulence? Maybe the pilot makes some minor shifts. They're changing altitude. They might even just be saying, hey, buckle your seatbelts and we're just going to ride through this. What they don't do is say, as soon as we hit turbulence, we're going to turn the plane around and go land at the airport that we left from. So I think that also is exactly the approach that we are taking with our clients. We've planned for a lot of unknown events, and we just have to continue to stay the course. So if you can hit the next slide for me, Jordan. This is probably one of my favorite slides. If you follow me on social media, you may have seen this slide. If you've been in a meeting with me, like a lot of you have, you probably have seen this slide. What we can see at the bottom are the years going from even 26 until through 2022. This is showing us any kind of down event of 20% or more. And that's indicated in red, and then the green is going to be on the upside. So what we're noticing here is there aren't that many downside events that occur that are greater than 20%. Definitely far more upside. And so this is where we go back to, it's really difficult to kind of time some of those scenarios and when to choose to get back in. And this is also why if we stay invested, we're going to see much more upside opportunity than we are having to avoid the downside. Can you hit the next slide for me, Jordan? So this kind of goes through a similar concept. Markets have rewarded discipline. And if we look at investing $1 starting in 1970, going all the way to present time, it would be worth $117. It's obviously magnified if we have more money in the market and we're investing along the way. But you can see all of these headline items between .com crash, S&P down 46%, 2008, real estate market crash. When we're in those moments, they're definitely very scary. But we know that, again, staying the course is going to usually be the best option for us and for the outcome of our clients' portfolios. Go ahead and hit the next slide for me. So we're doing this with an evidence-based strategy, which we've talked a little bit about before. So our investment strategy is designed with the full market cycle in mind, which is going to include corrections, bear markets, recoveries, booms, and we've stress tested your plan throughout all of this. So planning for uncertainty is definitely something that we've already baked into this. We understand what will be happening when the market goes down. So everybody's always really confident when the market's up, but I think everything gets tested, and what we are already planning for is those times when the market's not up. Go ahead and hit the next slide for us. So Marc is going to talk to us a little bit about the second key to our clients' confidence, which is diversification. You hear us talk a lot about that, but this is going to go beyond just the basics of diversification. So Marc, take it away.
Thanks, Sarah, and welcome everyone. Thanks for joining. As Sarah mentioned, did a nice job of explaining there's things that we can control here for our clients. One of those is just planning for uncertainty and doing a lot of things to help manage that process when things get both good and sometimes challenging in markets. The other thing we do for a lot of our clients, which is very key in determining their ability to have a successful investment experience, is just how we diversify. And I know that word is used loosely in a lot of times in investing, but the way we think about diversification is that we're very deliberate. We try to control what we can control, and we do everything by design for the benefit of our clients. And one of those, as you see by the title here, is diversifying beyond the basics for our clients. As you see the slogan, we like to own clients, or like to own a lot of the great companies of the world, and then some. And if we go to the next slide, we'll kind of jump into something that I've shown before in some of these webinars with many of you, or in one-on-one meetings. This whole notion of this 60-40 rule, where did it come from? You see it thrown out there a lot these days. And we're not saying it's good, bad, or ugly. It depends on the client situation. All we are saying is that let's understand where it came from and whether or not it's appropriate for our clients and how to utilize other information for investing. And the 60-40 really came about many, many years ago by some Nobel laureates. And it just said, hey, here's a way to allocate given what's available in markets. As you can see, it's a little bit small and noisy in the middle there. The back in the 50s and 60s, there wasn't that many ways to invest in public markets. You had big companies, you had bonds, you had treasuries, and maybe some other investments, and that was it. So that's really kind of how a lot of the investment ideas and ways to invest evolved since the 50s and 60s. But as we've evolved over time for our clients, we try to figure out ways to continue to diversify given our access to additional investments that we have now today. So if we go to the next slide, Jordan, you know, it's definitely over the last 40, 50, 60, 70 years exploded in mostly a pretty good way in terms of giving our clients access to investments that maybe can help not just diversify, increase return for their future goals and objectives, but also maybe just manage risk a little bit better throughout that experience and that process. So what we're looking at here is just this, it comes out every year in the beginning of the year, this overall 10-year forecast. And as Sarah mentioned, and she'll talk about it in a minute as well, we don't like try to forecast or throw darts or speculate on what's going to happen next. But a lot of the collective, wisdom of the crowd here gets together every year and comes up with what they think is going to happen for the next 10 years going forward for all these different areas of the market, also known as asset classes. And as you can see, there's this whole, you've seen US stocks, US fixed income or bonds, real estate, private debt, private equity, emerging markets, a lot of these, and not even everything's even listed here. And all they're trying to come together and say is, here's on average, as a crowd, what we think these asset classes might average per year for the next 10 years. Now, are they going to be right? Let's be clear, probably not in every situation. There's going to be other asset classes or some of these asset classes that might do better or worse than they forecast. But the purpose of showing you this is that, look, we're going to go beyond just traditional stocks and bonds for almost all of our clients of all ages at all times, especially where we can definitely better manage risk and maybe even increase return. And just a quick note, some people might have said when this came out at the end of the year, emerging markets being one of the best potential performers for the next decade, we might have got laughed at or thrown out of the cocktail party. Well, it has been a decent return asset class year to date over some of the things like US stocks or US fixed income. So again, this could always change, but you never know. And the point of this is that we diversify a lot, so we don't have to guess, speculate, or try to throw a dart at what's going to happen next. Let's go to the next slide. Now, while I've talked about things that we might include when it comes to other asset classes, like, foreign stocks, private equity, private credit, fixed income, which is one of the most basic investment vehicles, also known as bonds to some people, it's one of the most basic investment vehicles out there. And why I say that is because bonds have historically been a way to diversify stock market risk. Now, I bring it up because some people may find fixed income or bonds boring. They may stick with what they know in terms of buying corporate bonds or treasuries, but a lot of people don't realize, and a lot of professionals don't realize how bonds really work. And so one of the things this slide is showing, it says P&L from $1 million invested in just a broad bond market index, the profit and loss. And profit and loss for bonds is not just the price going up or down, it's also dividends and interest being paid. The point of showing you this is that, look, there's also things that we do include for client portfolios, but there's also things that we avoid because we think that some of the stuff you will lose money in if you invest in. And especially given how our interest rates over the last 30 or 40 years have changed, i.e. they're much lower than they used to be, there's a lot of risk that exists in owning fixed income. Either you don't achieve inflation, you're at the mercy of interest rates in terms of profit and loss, or you're just not going to help yourself earn the return you need for the future. And in this example here, some people might say, well, wait a minute, Mark, I see that every year you're showing here, for the most part, bonds made money. But what happened in 2022? This right here is not junk bonds. This is not, a high yield bonds or things that were not that great in the fixed income arena. These were just highly rated investment grade corporate bonds. Your Googles, your Walmarts, your Microsofts, the treasuries, they lost money in 2022 because interest rates went up. Now, we don't try to speculate, but given the information we have, we do know that things happen. And for a lot of our clients, we will avoid areas where they're not going to get paid to take the right kinds of risk. And this is a big, big area. As many of you know who invest with us, yeah, we own some traditional fixed income, but very carefully. And we own other areas in this asset class because we feel we owe to our clients to do better, to not just get better returns, but also to avoid doing what we call some of the stupid things out there in the marketplace that will cost you money. So again, we're very deliberate when it comes to this area, and many of you know we've been able to not just do this past year, the last couple of years, we've been doing it since back in 2018 and 19 when rates were going down close to zero and very low already. So a couple thoughts there. Next slide. And when I say investing with purpose, this is a good example, and we're not trying to cherry pick. We're just blindly looking at what happened in a year like 2022, which we just highlighted. You saw stocks go down, right? Almost 20%. Those are just public stocks. Bonds, if you just bought traditional stuff, you lost money. Even treasuries, you lost 13% or close to it. Now, as many of you know, we don't just buy traditional stuff only. When it comes to bonds, we buy a lot of other things. So our experience for clients was much better. Compliance might not like me saying that, but it was. And alternatives, we do diversify in alternatives, whether it's public or private, because it's something that, again, we're not necessarily trying to get the highest return for our clients. Our clients, if they do the right things, don't need to get the highest return, but they have to have a good positive return over their investment lifetime. And so by inserting some of these alternatives, right, and the way we know how to insert them as part of a client portfolio, it can not just ensure they achieve those goals, but we also can avoid some of the bumps that happen to the downside, like we just saw in the markets. So we like to, go beyond traditional investments when it's appropriate for our clients, just to help better manage risk, manage inflation, or the crisis or uncertainty of the day, as we call it here at CAM. Next slide. All right, this one's a little noisy, but it's just a very broad, basic example of that 60-40, looking at stocks and bonds. If you started to dabble in other different asset classes beyond just stocks and bonds, you can see that down here. It's a little hard to read. The return, about almost 9% over this last, 8-9 years, approximately. Volatility is what it is, and the yield. Here, blindly just adding some other asset classes beyond traditional stocks and bonds, it might get you a little higher return, but it definitely reduces the volatility. It reduces the bumps. So for a lot of our clients, again, some people out there in the marketplace might offer some of these asset classes, alternatives or private investments, just to look cute or try to sell something. We're doing it only when it adds value, net of fees and taxes for our clients. And that's really, really important to understand, because we don't want to have you invest in things that you don't need, right? But we know that almost all of our clients don't take on 100% stock risk or 100% equity risk, right? Because they don't need to, and not everyone can stomach those bumps. So we try to incorporate things where we think they're going to add value in a very deliberate way, and this is an example of that. Next slide. And then just kind of, rounding out my area here, my section here, we definitely like a process. We like a framework. You've heard us say that for many years. When it comes to public investments, we keep it very simple and deliberate. We like to diversify, keep things low cost, tax efficient, very simple, right? I think if the media and the magazines told you that out of the gates, they'd be out of business, right? They have to keep telling you something to keep you coming back. We do that for public investing very deliberately, and have done it for many, many years. We will utilize the investment alternatives if they can provide that value and be persistent, and it just, invest in non-traditional markets where it helps you achieve your goals. And here's a list of some of the things we do invest in for clients. You can go down the list and compare your own lineup. You can see there are some things that are different perhaps than some of our investors maybe have had or have now or may have in the future. But that's kind of an overview of some of the specifics that we do, especially in times like this. And Sarah, I think you're on.
Thanks, Mark. Great information. But essentially, when I'm thinking about rebalancing or just all the topics that we're covering today, and of course, coming back to confidence again, to me, confidence doesn't come from predicting the future. It comes from knowing how we're going to respond to it. So even with a great plan, diversified investments, we know that the market can drift. And that's where rebalancing comes into play. And it can be really hard to do, as we've gone through all of these, even in the last 20 years, various market events. Being able to say, hey, I know the market's down, but we're going to take something from a more conservative area. We're going to move it back into the things that were down can be kind of challenging. So we do want to make sure we're focused on that disciplined rebalancing process that helps our clients buy low and sell high in a more measured and consistent way. So that looks like when one area of the portfolio outperforms, we trim it. And then when another area lags, we just add to it. So Jordan, do you have the ability to show, do you have the slideshow up?
I do, yes.
Okay. Okay, I can't see it. So in any case, you can see it? I can't. Okay, I think the first one, if I recall, and let me just grab my copy of the slides here, but it's talking about when the market has a 10% or greater drop, what is the estimated annualized return after that? So I think the first one was like 11.7 over a 1-year period. Then it jumps to, I think it was 10.3% over a 3-year period. So essentially what we're looking at is, you know, what we are knowing with a lot of this, again, evidence-based material is if we do have a market that goes down and we know that the market's adjusting, you know, or whether 10, 20% or greater drop, that evidence is showing us that it will come back. We almost always know that. So this again goes back to, we have to stay consistent and stay invested. And we also have to be able to focus on and consider rebalancing. So Jordan, if you can hit the next slide, we're going to look at what portfolio drift can look like. So this is a little example during COVID. I know, I can't believe it's been 5 years, but this is an example of what a portfolio would have looked like. Let's just say if we were to take a 60-40, we know 60% is allocated toward equity. If we were to have the last rebalance for that portfolio on December 31st, 2019, just over the course of that first quarter, already our portfolio has drifted to probably about 55% in equity. And then after the markets recovered, if we did go ahead and rebalance on March 31st, we go back to 60%. Then by the time we hit June, the end of the second quarter, we've already drifted and we're out of balance. So a couple of things, we probably want to do rebalancing when called for and not just waiting for a quarter, which is something that we do. But then you can kind of see in real time that if your plan or your design was built on, I need to have this strategy of a portfolio, be it 60-40, 70-30, whatever we're calling it, we do want to continue rebalancing on a regular basis so that we can stay consistent with that strategy, because drift happens, not just on the allocation, but even within the investments. Go ahead and hit the next slide, Jordan. So we should be looking at why financial planning guides investing. So this is actually a snapshot. If you've done financial planning with us, what you're looking at is the asset spread for a client's lifetime, say this year going all the way out until they're like 100 years old. This is a sample case. We have, you know, Mr. and Mr. Smith's sample client here. The planning we do, so if you're from Florida and you're aware of the planning for hurricanes and spaghetti graph models that we all watch as we're preparing for a hurricane, it gives you a spread of where is this thing most likely to fall? And that's kind of what this page shows us. So it includes about 1,000 different iterations of various markets, inflation, rates of return, all kinds of things can happen because we know planning doesn't look like we get 7% every single year. So we have to take that into account. And this particular model is showing us that, you know, Mr. and Mrs. Smith are both fully going to be retired at 67, 65 years old, how much money they have, and then what we're projecting it to look like all the way until they're passing. Now, what we haven't seen was before this, we had to make some adjustments to get here. You know, maybe we had to save a little bit more. Maybe we needed to adjust what their allocation was, but we got to a place where we were successful. And so this is where I come back to, if we've already planned for, again, 1,000 different scenarios, up and down markets, a variety of things to happen. If we have a plan like this in place, This is what gives our clients confidence to know that I don't need to worry about what's happening on a day-to-day basis because I have this plan that I can lean back on. Go ahead and hit the next slide for me, Jordan. So just to kind of summarize some things here, or at least with, investing with a purpose, as we're talking about rebalancing as well as investment, then, investing can feel emotional, especially if there is no plan. So we don't want decisions to feel like a guess. We want to be able to put our plan in place. It gives us direction on what to expect. It gives us direction on how and when to rebalance, how much risk we need to take. So, the last line here, without a plan, volatility can feel like chaos. With a plan, it's just part of the design. So people are knowing what to expect. And again, that brings us back to a lot of confidence. So Jordan, let's just go ahead and move to the summary here. So recapping some of the things that we've talked about. Number one, what's making our clients confident? Number one, it's staying the course, whether it's staying invested, not making major changes, not abandoning the plan or the strategy that you put in place. We just don't want that short-term noise to derail our long-term plans. And number two, we want to talk about elevating our strategy, and that's with expanding diversification. I think a lot of folks even still today are focused primarily on even just the S&P 500. A basic strategy would give us more diversification, but a lot of the things that we're bringing to the table go even further beyond that. And I think that also helps to create a more confident structure and outcome for a lot of our clients. And then number three, rebalancing with intention means that we know why we're making changes and for what purpose because of their plan. And that will help us in any market environment. So that's it for our presentation today. We do have some questions. I would encourage you to put questions in the chat. But we'll kind of open it up at this point. And let me see. So a few things that we've had folks ask are, how do you decide what to sell and buy when you rebalance? Marc, do you want to take that one or?
Sure, yeah, and I can take that one. So there's, I think I mentioned it a minute ago, and so did Sarah, there's a lot of things that we control and don't control when it comes to markets. Rebalancing, we do control. While there are a lot of things we use technology for to alert us, keep us up to date, not just for individual clients, but all clients, we're very thoughtful about it, and we still control the process on whether we should rebalance somebody's portfolio. We have investment policy statements that drive a lot of our decisions, right? And it keeps clients' portfolios in balance. And if something gets out of balance, like we see on occasion, and we just saw recently with all the volatility, we want to bring that back into balance because chances are nothing has changed in your life, like Sarah highlighted, but we want to make sure that we're always maintaining that level of risk and return for your benefits. So we will bring things back into balance as needed. It shouldn't happen that frequently, even if markets are very volatile, if we've done a good job of setting the portfolio up, but we will make those rebalancing decisions. We are thoughtful about taxes too. We don't just blindly sell things and rebalance or buy things. If it's going to cost you money, we always try to be careful around that and be careful around costs. So we don't just trade every day. We have minimum rules in place to trade efficiently, be mindful of taxes, but we still push the buttons, only when it makes sense for you.
Awesome. Another question we have, I think we've got time for maybe two more questions. I know we're kind of coming up on our time here. What if I want to invest more right now? Is it better to wait or invest all at once? I think going back to many years, a lot of the studies and research that we've always reviewed does indicate that, the concept of getting invested now usually works out to your benefit. So We're not timing, we're not, trying to figure out when we should get back into the market. We should just add funds into the market when available. But having said that, I think there are some situations where we have gone into like a dollar cost average scenario. People do that anyway with their 401ks as they're contributing whenever they get paid. So sometimes we'll just take the approach of evaluating the client or the individual, kind of work out a strategy of what works best for them. So let me see what else here. Let's do one more. Some of these, we kind of covered taxes already. Is rebalancing handled differently for retirees versus people working? Marc, do you want to weigh in first? And
Yeah, it's good. It's a good question because we get that question or something similar a lot. We typically still have a process. We still have an investment policy statement that drives the decisions on how much they should own in stocks, bonds, alternatives, and whatnot. It can be done differently if somebody, for example, is withdrawing money from the portfolio. If they're not withdrawing money from the portfolio, then it may not make any difference, right? We might be able to easily rebalance with flexibility and very quickly. But if somebody, let's say, is rebalancing or withdrawing money from the portfolio, we then want to be mindful that they can always do that. They can always do that with full flexibility whenever they need it. We don't want to ever be in a situation when someone's withdrawing money from their portfolio to meet their retirement income needs each month, each quarter, each year, and then they have to sell at the worst possible time. So when we rebalance, we're mindful of where to pull funds from, right? Depending on market conditions, depending on their cash reserve, because we don't ever want to do something that's going to cost our clients money if we can avoid it. So it does impact it, but we have a rules-based process to manage that.
yeah, and I would add not only to that, we usually have this plan or strategy figured out well in advance, or as somebody is preparing for retirement, how to have enough like liquidity or cash reserves set up that won't be disrupted. And this is also where we've kind of created a lot of how to create some guaranteed income or more stable income sources, whether it's their Social Security, pension, or some other type of, essentially looking at their essential expenses and then knowing that whatever else we have invested longer term, we can rebalance and adjust accordingly. So excellent. Well, it's 12:35 Central, 1:35 Eastern. I would say we probably need to wrap it up because I know folks are having to move on with their day. We will send out a recording if anybody's requesting it and they want to see these slides and some of the material again, but certainly reach out to us if you have any questions or want to do some follow-up on this. And I think that is it for today. So thanks everybody for their time.
Thanks, everyone. Appreciate it.